I'm going to monitor the chat, but thank you. First of all, thank you everyone for coming. We really appreciate it. We're so thankful for Steve and Chad to be here today to give this presentation. There are 3 topics that we're going to cover, and if you could save your questions for each topic, you can put them in the chat, but we're going to answer them after each section so that we don't interrupt the presentation as it's going through each section. So again, feel free to use the chat. I'll monitor the chat, but Steve and Chad, take it away.
All right. Well, thank you, everyone. Good afternoon. It's nice to be with you all today. As Ann mentioned, we have 3 topics that we'll go through today. So the first being the employee retention tax credit. Then what would be a presentation without some PPP discussion. And then we'll talk a little bit about just some of the issues around people relocating and what that means for payroll reporting, income tax reporting, things like that. So, and again, as you have questions, please feel free to type them in the chat. And if we don't get a chance to address all your questions, Steve and I will certainly reach out to you and answer them as best we can. So just really quick, I lost the ability to advance the slides. There we go. Sorry about that. So my name is Chad DeGrasser. Again, I'm joined by Steve Minson. So we're with DGC. We are a CPA firm specializing in architects and engineers. So I recognize many of you from prior BSA events, so nice to see you all. So that's the agenda, and as I said, the first topic that we'll be getting into is the employee retention credit, and so I will turn it over to Steve, who will lead us through that discussion.
Thanks, Chad. Hopefully we can answer some of your questions today. My guess is that will create a lot more questions, and I apologize in advance if our guidance seems vague, because the IRS guidance has been vague, and a lot of the answers and a lot of the examples that we'll go through are not geared to architectural firms, but we will we'll talk about the examples that we do have, and we'll try to put it into we'll try to create some examples that are more indicative of your business. So this slide we've got here right now is just a chart that I put together that sort of compares the employee retention credit as it was enacted by the CARES Act over in the far right-hand column, and then shows the changes in the left column as it was amended recently by the Consolidated Appropriations Act. And many of you probably took a look at the original enactment of the law back I think it was late last March. And one thing stood out. A business that took out a PPP loan was not eligible for the employee retention credit. And rather than keep saying employee retention credit all the way through, I'll just refer to it as the ERC. So if you looked at it and said, okay, the PPP loan is certainly much more valuable, then I'm not even going to worry about the ERC credit, so you'll probably ignore it, which is really what happened, and it largely got ignored by most businesses. So we went through the year. 2020 was an interesting year, to say the least. And all of a sudden, the new relief bill was proposed towards the end of December. It was passed by Congress. President Trump at the time threatened to not sign it, but right towards the very end of the year, the last few days of the year, he did sign it. And now we've got a brand new bunch of new tax law changes, some new PPP provisions. And all of a sudden, the one thing that was thrown into the employee retention credit, along with some expansion of the credit, is that a qualifying business, and I'll get into the qualifications in a minute, but a business that qualifies that took out a PPP loan may now qualify for the employee retention credit. So all of a sudden, we've got to take a step back, go back in history into 2020, see if a business qualifies, and if they did, maybe go back and amend some tax returns. There was a provision put into place that said that if you did qualify for, say, the second or third quarter of 2020, you could catch up and claim the credit on your fourth quarter of 2020 payroll tax return, which was due January 31st. The IRS never really published any formal guidance. They came up with something about 3 days before the returns were actually due. But by that point, most people had actually already filed their fourth quarter payroll tax return. So effectively, it was too late to really do anything on that return. So if you do qualify, if the credit is of any value to you, and we are talking to a number of businesses where even a small business of 20 and 30 employees, I've talked to one that probably has $100,000 credit potentially. So if you do qualify, it really can be a very, very beneficial credit. But there's a lot of roadblocks to overcome, as we'll talk about. And the other factor is you will have to amend your tax return, which is just one more little stumbling block. So just this chart just really summarizes the rules very, very generally. Originally by the CARES Act said that the ERC was in place from March 12th through December 31st of 2020. It has now been extended through June 30th of 2021. So we've got 6 more months of dealing with it. The eligibility rules, which I'll talk about in a little bit more detail, in very general terms, either you have to have been shut down either fully or partially by government order, or your gross receipts had to have declined by a certain percentage, and that number has changed from 2020 to 2021. So we'll talk a little bit more about that. PPP loan interaction we spoke about already. And the credit has in 2021 is larger than it was in 2020. So there's some benefits there, and we'll talk about the employee threshold as well, because that may impact some of you. So Chad, if you can flip on to the next slide. We'll start to talk a little bit about the eligibility rules, and this is where it gets very interesting and can get very confusing. So, as typically happens in a tax law, the IRS will the law itself is usually not crystal clear. It answers some questions, but it leaves more questions unanswered than answered. And the IRS will issue some form of guidance. That guidance is usually in the form of a regulation or a revenue procedure, something fairly formal. In this case, the IRS has not issued formal guidance, or what we as accountants would consider formal guidance, but they have issued FAQs or frequently asked questions. They can sort of skirt the issue a little bit in that because it's not formal guidance, they might try to argue that you can't depend on it, but really that's all we have at this point in time. So it's something we sort of have to fall back on these, and I've given you the link. There's about 94 of them, I believe. So it's not a short list, but the link is here on the slide as to where you can find these FAQs. But the short answer is that an eligible employer is one that had either fully or partially suspended operations during any calendar quarter in 2020 due to orders from the governmental authority that limited commerce, travel, or group meetings due to COVID-19. Or you experience a significant decline in gross receipts during a calendar quarter. Now, in many cases, a business may find if they had fully or partially suspended operations, they may also have a significant decline in gross receipts. But we are finding some that had one and not the other. So you really have to look at both, and you can meet either one of them. And you're considered partially suspended if the governmental order imposes restrictions such that you can continue some, but not all of your typical operations. And over on the next slide, we see that they define a significant decline in gross receipts. You look at the first calendar quarter in 2020 in which your gross receipts declined by more than 50% when you compared to the same calendar quarter in 2019. And the significant decline continues through the calendar quarter in which that gross receipt decline does not increase I'm sorry, in which your gross receipts do not increase to at least 80% of the prior year's quarter. So as an example, let's say in the second quarter of 2020, in the second quarter of 2019, you had $1 million of gross receipts. If in that same quarter of 2020, the second quarter, your gross receipts were under $500,000, then you experienced a greater than 50% decline. So you're eligible for the second quarter. You would then continue to be eligible for the next quarter no matter what happens. So once you're eligible for one quarter, you can continue into the next. If in that third quarter of 2020, your gross receipts increased to more than 80% of the prior year quarter, then you stop at the end of that quarter. So let's say, for example, you had $1 million in the third quarter of 2019, and you had over 800,000 in that third quarter of 2020. You've now exceeded the 80% threshold. So you stop at the end of that quarter, but you're still eligible for the second and third quarters. So you'll get at least a 2-quarter hit. The nice thing, however, is the Consolidated Appropriations Act amended the gross receipts definition so that you now only have to have a decline of greater than 20% beginning on the first quarter of 2021. So a lot of businesses are saying, yeah, my gross receipts dropped by 30 or 40%. So I don't meet the 50%. The 50% is pretty tough to hit. You really had to have suffered badly in order to meet that 50% test. So I'm sure a lot of restaurants and gyms and businesses like that met, but professional service firms as a whole may not have met that threshold. The 20% threshold, on the other hand, in 2021 may be a different scenario. So one of the things you'll also find is that the Consolidated Appropriations Act also said you can look back one quarter to determine if you meet the test. So let's say, for example, that your 2021 first quarter gross receipts, which obviously you don't know the answer to yet. Let's say that the gross receipts in the first quarter of 2021 are equal to your first quarter in 2019. So you actually look back 2 quarters for comparing 2021 to 2019. But let's say they're equal, so you don't meet the 20% test. But you did meet that 20% test in the fourth quarter of 2020 when compared to the fourth quarter of 2019. You can then carry that forward and take the credit in the first quarter of 2021. Now, taking a step back, the FAQs that the IRS have published to date, and if you go back and look at the site that I put on the previous slide, the FAQs are based on the CARES Act, the old law. So they have not yet been updated for any of these new provisions we'll talk about today. So once the IRS issues some guidance, it's possible that the way we've interpreted some of these rules may change. But so anytime I talk about the Consolidated Appropriations Act, I'm basing it on the law as currently written, and there is not yet any IRS guidance. So just keep in mind that there is a possibility some of this could change as we get better guidance. If you flip over to the next slide, so under the CARES Act, as I mentioned earlier, you were not eligible to claim the ERC if you also took out a PPP loan. That restriction has been removed. However, keep in mind the same wages cannot be used for both. So if you have used your let's just say you used the 24-week period, and it covers the second and third quarter, as well as possibly some of the either fourth quarter or possibly some of the first quarter even for your PPP loan. If you use those wages for PPP loan forgiveness, you cannot use those same wages for the ERC. So even if you qualify in the second quarter, as an example, if you've used all your wages during the second quarter for PPP loan forgiveness, you can't double dip and take the ERC as well. Some businesses I know have not yet applied for their PPP loan forgiveness. If you haven't, you might have a little bit of flexibility in choosing which wages that you use for forgiveness purposes. But if you've already applied, you're pretty much stuck. So unfortunately, I'm sure some businesses took the approach the simple approach and said, okay, I can get forgiveness by using just wages. I'm just going to make it simple and apply for it based on that. Unfortunately, because the Consolidated Appropriations Act was passed so late in the year, it didn't give you an opportunity to sort of plan out how to use those wages for PPP loan forgiveness and ERC and how to maximize both of them. So that flexibility may exist in 2021, since we sort of know up front how to best apply these things. But if you have applied, you're unfortunately, we're not aware there's any flexibility in changing that approach. The other thing to consider is that under the CARES Act for 2020, if you had more than 100 employees, so I'm sure that some of you are under 100, some of you may be over 100, but if you were a business with more than 100 employees, you can only claim the ERC on those employees that are not currently providing services. So again, my guess is that will not apply to too many businesses, but if for some reason you kept somebody on payroll, but they were not working, then you may be able to claim the credit for those employees. On the bright side of things, the Consolidated Appropriations Act increased that threshold up to greater than 500 employees. So for 2021 purposes, as long as you are 500 employees or under, you really don't have to worry about the non-working versus working piece of it. So over on the next slide, as I mentioned earlier, so the FAQs, like I said, there's 94 of them. They go into some detail. They may create more questions than answers, but we will go through some of those. One of the FAQs does talk about the fact that employers that operate an essential business may be considered to have a partial suspension of operations if more than a nominal portion of its business operations are suspended. And the word nominal is bolded here because I think that's a very important concept that we have to talk about. And we'll mention the word nominal several times throughout the course of this discussion. The problem is the IRS doesn't define nominal. So it's sort of up at this point, it may be up to our own interpretation. They have at least one example where they talk about what is nominal and what isn't. But that's an issue that we're concerned about greatly as to how we might consider what we might consider nominal and what the IRS might then consider nominal. Also, it's important a business is not deemed to have a suspension of operations if it's deemed it's an essential business, but its customers are required to close. So that seems a little harsh. Let's say all your customers end up closing and you have no business. You're not deemed to have closed even if you're an essential business under the governmental orders. On the other side, if all your customers are closed, you'll probably hit the 50% reduction in gross revenue. So you shouldn't have a problem qualifying for the credit, but you are not deemed closed. Also, if your workplace is closed by governmental order, but you're able to continue operations on a comparable basis by having your employees work remotely, which a lot of us have done, then your operations are not considered to have been fully or partially suspended. So as long as you're able to sort of operate in a comparable manner to how you did before, it's obviously different, but everybody's able to function normally, relatively normally, then you're not considered suspended. So on the next slide, we've got an example from the sorry, I got muted accidentally. So if you go to the next slide, there's an Irs example that we talk about here, and this is a good example of again, it's not necessarily up in your line of business, but it's a good example of how the IRS has interpreted a partial suspension of business. In this case, a scientific research company operates in a state where the governor has ordered that only essential businesses may operate, but their operations are conducted in a laboratory setting as well as through the use of computer modeling. They're not essential, so the workplace, the office must close. However, their laboratory-based research operations cannot be conducted remotely. Although the employees that operate the rest of the employees that do computer modeling can operate remotely, and they do. Because a number of the employees of the business cannot function because they cannot get into their lab, that is considered a partial suspension of operations. So looking at this from an architectural standpoint, best example we've been able to come up with is what if you are in a phase of your design work or construction administration where your employees are on site at a construction site and that site is closed. The question comes, can that be considered a partial suspension of operations? And unfortunately, since the IRS has not given us clear guidance, I think there is an argument that says it may be. However, if you're able to take those employees and reallocate them somewhere else, there is also an argument that says that is not a partial suspension of operations. I know there are consulting firms out there that are taking the position that once you're shut down for even a day, that could be considered a partial suspension of operations. However, we are concerned that would be considered nominal by the IRS. So if you've got that type of situation, it probably needs to be discussed in some detail just to make sure and sort of take a look back and think about how it affected your business. Were the people able to reallocate, work on other jobs? Did it really impact your business? And if it did, there's a good chance you should qualify for the credit. At this point, we don't know how much the IRS is going to challenge some of these rules, but that's something that hopefully will get clarified at some point, although I'm not exactly holding my breath. Next example is, I think you may have skipped the slide, Chad. Next slide. Sorry. There you go. So if the workplace is closed by governmental order for certain purposes, but it remains open for other purposes, or the employer is able to continue certain operations remotely, it's partially suspended, as I talked about. If all of the employer's business operations may continue, even if subject to modification, for example, to satisfy distancing requirements, such a modification is not considered as partial suspension of operations unless the modification required by governmental order has more than a nominal effect on the business operations. Again, that word nominal. And the next slide, we'll see an example where you've got a restaurant that has it's closed to on-site dining, but they're allowed to continue their sales through carryout or drive-through or delivery. They would be considered to be partially suspended because the indoor and outdoor dining services are closed. Next one is where the decent example, I guess, of where nominal comes into play. So this is a grocery store, which is obviously an essential business, so remains open. However, the governmental order requires that the stores discontinue their self-service offerings such as salad bars. But they are allowed to offer prepared or prepackaged food. In this case, the grocery store modified its operations to close its salad bars, but it did offer prepackaged salads and other items. Under this example, they are deemed to have only a nominal reduction in their activity. Therefore, they are not deemed to have a partial suspension of operations. So they would not be eligible for the credit. And finally, wanted to just talk about just a few a few just general topics related to the employer retention credit. Obviously the numbers are important. What kind of credit can you be looking for? So under the CARES Act, the credit was equal to 50% of up to $10,000 of qualified wages per employee for the year. So if you qualified for any one quarter, let's say you qualified for just one quarter, you would look at your wages for that quarter. Each employee up to $10,000 per quarter qualifies. So if everybody made at least $40,000 per year, then everybody would qualify, and you'd be able to take 50% of their wages, or $5,000, as a credit. Again, you're limited to that $5,000 per employee for the entire year. So if you had 50 employees at $5,000 an employee, you got a $250,000 credit. Not a bad little credit if you do qualify. On the other hand, in 2021, the Consolidated Appropriations Act increases that credit to 70% of up to $10,000 qualified wages per quarter rather than per year. So now you're going to look at it for the first and second quarter, and you'll get a credit of $7,000 per quarter per employee, or $14,000 per employee for the quarter. So instead of getting $5,000 per employee, you're now getting $14,000. So you're getting a much larger credit for 2021. Besides the fact that you have a much easier qualification process in 2021. As I mentioned earlier, the gross receipts test for 2021 may be met by looking at the immediately preceding calendar quarter. There are also some aggregation rules I'm not going to talk about right now, but if you had related businesses, you might have to aggregate them together for purposes of determining your number of employees or the reduction in gross receipts. Won't get into those details, but if you do have any related businesses, we should have a little bit further discussion about that. And on the final slide, I believe on the ERC, is you can also qualify with respect to your health plan expenses. So if you had, let's say you had an employee that did not earn $10,000 in wages in a calendar quarter that you qualified, but you had health plan costs paid for by the employer or paid for by the employee under a pre-tax arrangement, you can use those health plan costs to qualify for the credit. So you may be under, your total wages may be under 10,000, but you might be able to increase the amount of the credit because of health plan costs. However, the one kicker is that if you do qualify for the ERC and you do claim the ERC, the amount of the credit that you claim will serve as a reduction to your total expenses deductible on your income tax return. So if you had a $100,000 credit in 2020 on the ERC, you will have to add that back to your income taxes. You're still ahead of the game, way ahead of the game technically, but but there is a little bit of a kickback on the credit, basically increasing your taxable income. And so if you have not yet decided or not yet determined whether you qualify for the credit, but you want to file your income tax return by its due date of either March 15th or April 15th without extending, then you either have to make a decision pretty quickly on the credit, or you would have to go back and amend your income tax return, or you would have to extend your income tax return. I might suggest the extension just to simplify everybody's life, but it's probably worth making a decision as to whether or not you're going for the credit prior to the time that you actually file your income tax return for 2020. And with that, I will see what we have for questions.
We do have a few questions. The first one is about gross receipts. It's a common question that came up in the PPP stuff too, but when they refer to gross receipts, do they mean money received from clients, or are they referring to gross revenue?
Great question, and one they haven't answered yet. The approach that we've taken, and it's similar to approach that we've taken with the PPP loans, is if you have financial statements, and if you have accrual basis financial statements that are either audited or reviewed, or even a compiled financial statement, we believe that's probably a more reasonable picture of your gross receipts as opposed to your cash basis gross receipts. But if you don't do external financial statements. If all you do is a tax return, then I guess we would argue that your cash basis tax return is really all you have to go by. So I wish the IRS had answered this one because it would make everybody's life a little bit simpler. But if you if you have financial statements, your best answer is to use those. If you don't, and you do have all you have is a cash basis tax return, probably best to use that. At least something that you can support your number on.
Yeah, and I guess I would just add to that, we're certainly recommending that clients look at it both ways. And if there is, and if you meet it, under the different methods in both scenarios, then obviously you're fine. If it's one or the other, then, we would just recommend, talking to your CPA and really talking it through. Because, if there is an audit and you're required to produce the support, they're likely going to ask you for your trial balance. And while you can certainly prepare one on the cash basis, they're likely to see that you've got receivables on your balance sheet, and they're going to want to understand that. So, again, as Steve said, the guidance isn't clear. We wish they would come out and formally address that. So it's certainly something that you should calculate both ways if you don't have a financial statement prepared, and then really talk with your CPA about, whether it makes sense, to qualify.
Okay. The next question is the 20% in 2021 based on 2020 or 2019? What are we comparing?
We're comparing that to, you're comparing 2020, you're comparing the quarter of 2021 to the same quarter in 2019. So you're basically comparing what's going on right now to the last year that was normal. And since a lot of businesses had good years in 2019, it wouldn't shock me if we see a 20% drop in some cases from 2021 to 2019.
But wait, you're taking 2021 and comparing it to the first quarter in 2020, right?
No, 2019.
Okay, so you go back 2 years, or
Right.
Okay.
Yeah, go back to 2019. Basically, you think the first year of comparison, no matter whether you're looking at the 2020 year for the ERC or the 2021 year, the comparison year is going to be 2019.
Okay.
In both cases.
And then the next question is, if we meet the 20% in quarter 4 of 2020, does the credit period start from the fourth quarter going forward, or can you use all of 2020?
No, if you meet the 20%, the 20% technically does not apply until 2021, but you're able to look back for the first quarter of 2021. You're able to look back to the fourth quarter of 2019, just for purposes of that test only. So if you met the 20% test in the fourth quarter of 2020, you can apply it. You're eligible for the first quarter of 2021. I think what they're getting, I believe the purpose here is they thought that businesses may be starting to see a recovery. So they may not qualify in the first quarter of 2020, but you may have qualified in the fourth quarter of 2020 under the new rules. So they're giving you a little bit of a break.
And then next is, would receipts include reimbursements for incidental expenses, for example, COBRA payments and employee purchases?
I probably would not include those because I don't consider those part of your ordinary business gross receipts. But again, they've really never defined gross receipts. But if you think about the intent, they're trying to help businesses whose business has suffered. And COBRA reimbursement, for example, really isn't part of your normal operating business.
So, and just one last question I didn't put in the chat because it's mine. We've been approached by lots of different people saying they can help us qualify for this credit. Who should we turn to? Our payroll company, our payroll provider, our R&D tax credit consultant, our CPAs? Who do we get help from, or where would you turn?
Well, it depends on there's no perfect answer. Just about from what I've seen, just about all of the the businesses that provide R&D credit studies are operating in this area as well. So they're certainly in a position to help. What I've asked, the ones that we work with, we've spoken with, we've asked that they at least coordinate with us just so that we're aware that it's going on, because you know, there may be some issues that we're aware of that they may not be aware of. You know, our feeling is, you know, I think it's important to understand what their fee structure is and how much it's going to cost you. I know we've spoken with at least one that are operating on a strictly contingent fee basis, and I'm not 100% comfortable with that approach, only because, you know, typically the IRS does not look strongly at contingent fee arrangements, and under the guidelines we have to follow with the IRS, we're not allowed to charge a contingent fee. And most of the R&D credit providers will structure their fees such that it's time and material, sometimes with a cap, but it's not strictly contingent fee, because sort of the prevailing theory is that if you have a strict contingent fee, it's certainly to your benefit to get as much of a credit as possible. So I would recommend that if you are talking to somebody about it, understand how they're going to bill you and how much it will cost up front. But we think we should be involved, at least on a, you know, your CPA should be involved to understand that you're going for it, because it could impact the income tax return. So there should be some involvement with the CPA.
Yeah, and the only other thing I would add to that is, you know, right now we still think that, you know, most firms, if they do qualify, will have the ability to go back and amend their payroll tax returns. And so there's time to hopefully wait for some additional guidance to come out. So rather than maybe rush a filing that's based on some just, you know, inadequate guidance, I guess I would say, or just not fully vetted guidance, you know, we would say, you know, probably makes more sense to just wait and see if that additional guidance comes. So don't feel that you have to get it done, you know, right away. That we still do think you'll be able to amend to go back and capture these credits.
That's at least for 2020, but for 2021, you might want to, your goal might be to want to make a decision by the due date of the first quarter payroll tax return, which is April 30th. So you probably want to have an idea so that you can file, you can claim the credit on that payroll tax return.
Great. I think we can move on to the next topic.
Right. So
Thank you.
PPP2. So we'll move quickly through this because I know many of you are pretty familiar with PPP. But just really wanted to highlight that the applications for PPP2 are due by March 31st of 2021. So just keep that in mind as you're getting all your documentation together and so forth. Just some notable changes. So for PPP2, not more than 300 employees, 25% gross receipts decline in any quarter in 2020 versus the same quarter in 2019. So that same discussion that we had around the retention tax credit in terms of whether you use accrual basis, whether you use cash, it's also impacting PPP2. So something to certainly look at for both. And then, you know, I don't think anyone will really have an issue with this, but you must have fully used the first loan amount to apply for the second round. 2.5 times the average monthly payroll costs. You can use your 2019 data. So the same exact data that you used for your PPP1, you can turn around and use for PPP2. You don't have to redo the calculations. But we would certainly encourage firms to look at the calculations that they did perform in 2019 because, or I should say based on 2019, because at least a lot of firms that applied very early on, the guidance regarding what you can include specifically for owners was changing. So depending on what you ended up including for owners, and maybe even some employees regarding health insurance, retirement, things like that, you just want to go back and take a look to make sure that you're maximizing the loan amount. The same split in how you have to spend the money exists. So 60% on payroll, 40% on other costs, but they did expand that other cost bucket. So now in addition to rent, utilities, there's also software and cloud computing costs, any costs related to PPE. So, masks, shields, anything that you had to do to secure the offices, things like that. And if you had any property damage costs, those are all now eligible. And they're also, and correct me if I'm wrong here, Steve, retroactive. So this expanded bucket of costs also applies for round 1 as well as round 2. So the caps are the same for the employees and the owners, and this is the base salary cap for the employees. So 8 weeks at the $15,385, 24 weeks at the $46,154. So again, for employees, that's base salary. On top of that, you can add the employer share of health insurance, 401k, company contributions, state unemployment taxes. For owners, it's a little different depending on the type of entity. So C Corps, S Corps, LLCs, there's different rules around that, but just know that the limits are different for owners than they are for normal employees. There's simplified, and many of you, if your loans are under 150,000, you'll see on the Treasury's website that there is a simplified application for forgiveness for round 1. So certainly take a look at that. If you haven't, it drastically reduces the information that you have to provide when applying for forgiveness. You still have to maintain all that documentation if there's questions or an audit, and obviously to make sure that the amounts you're claiming are supported. But it's a significantly streamlined application if your loan is less than 150,000. There's obviously questions around 8 weeks, 24 weeks. The good news is that you can now use really any period of time in between 8 and 24. So they've clarified that it's not an either or anymore. So if you've finished expending the money through week 16, you can use through week 16 essentially for your covered period. The other point to that is when you're looking at headcount and FTE calculations, again, we think that you have to look at, for purposes of the covered period, through the date that you fully expend the funds. So if it's through 17 weeks, that's sort of the end date that you would use for your FTE calculations. You don't have to go all the way out to 24 weeks for purposes of the headcount analysis. So again, documentation is key, and making sure that, as Steve said, if your receipts are certainly qualifying the reduction for both the retention credit and PPP2, that we're sort of looking at both of those and trying to maximize the utility of the credit as well as PPP2. So that might require some planning. And so obviously working with your CPA to make sure that you can maximize both of those programs. And, again, the bank has 60 days to review, 90 days for the SBA. There is a 6-year audit window of time that they can come back to ask for documentation. So just to be aware of that, if you have any file retention policies that are less than that, you want to at least make sure you're maintaining the files that support your PPP forgiveness application. Won't really go into this, but if any of you are considering a merger or a sale, just know that there are some issues around PPP that have to be addressed. And all of this similar stuff. I will say that we don't think that you have to put the funds in a separate bank account. It's certainly a good practice, but we don't think that that's required to do. And I think that's anything else you would add on PPP2, Steve, before we see if there's any questions?
Yeah, I guess the only the one point I'd add is an income tax piece of it, and that the earlier in 2020, the IRS had issued guidance initially stating their position that the expenses that you paid for with the PPP loan that would not be deductible if the loan was forgiven. Congress was very adamant that that was not their intent. Finally, it took them about 8 months, but they finally did pass a bill as part of the Consolidated Appropriations Act. They did pass a section that clarified that any of the deductions, any expenses that you paid would be deductible. So that put that problem to rest. However, it created another problem in that it's unclear sort of when this forgiveness happens. Is it a 2020 or a 2021 transaction? We're not sure yet. That impact is most important for S corporations and partnerships, because the PPP loan forgiveness, even though it's non-taxable income, increases the basis of S corporation shareholders and partners in partnerships. So it's important, especially if you've got a loss. It's possible that the members may need that basis created by the loan forgiveness. So if you are a flow-through entity, that's something you may want to look at. You may want to consider what year is appropriate. Hopefully the IRS will issue some guidance on that, but we've got some ideas as to how to apply it, but the answer may be different depending on your facts. The other problem is that the states are being very inconsistent with how they apply it. There are some states that say that even though it's non-taxable income, the loan forgiveness is non-taxable income for federal purposes, it may be taxable for state purposes. On the other side of things, some of those deductions, some states may say that the deductions are not deductible. It's sort of a little bit of a nightmare, to be honest, and trying to deal with it all. But not that Massachusetts is ever difficult, but the answer in Massachusetts is even more convoluted than in most states. If you are a C corporation, Massachusetts law follows the current federal Internal Revenue Code. So whatever the federal law says, Massachusetts will say for C corporations only. So if the loan forgiveness is non-taxable, the expenses are deductible, no problem. If you're an S corporation or a partnership, however, with individuals as the owners, Massachusetts law for individuals, believe it or not, still follows federal law as of January 1st, 2005. That's a 16-year-old law at this point. So because the changes are very recent to the federal law, Massachusetts does not follow the loan forgiveness rule for purposes of individuals. So if you're an individual owning an S corporation, you could end up with additional taxable income for Massachusetts purposes only. However, legislation has been proposed to change that and to bring it in line with federal law so that it would be non-taxable. I have no idea right now whether that law will make it through, and if it does, when that will happen. So that's something to keep an eye on. Again, talk to your accounting firm, and it may be worth extending your tax return until that's clear, until all that is clarified. Very, very several reasons why tax returns may not be able to be filed by the normal due dates this year. But that's sort of my issues with the PPP loans from a tax side of things. Any questions?
There was one question in the chat. Well, was a statement. The gross receipts on accrual basis is tricky when a portion is earned income on fixed fee projects.
Yeah, and that's percent complete accounting issue that creates those billings in excess or cost in excess adjustments is an area that we hope there's guidance issued on. But right now we would say that all the rules that we know of, if you do prepare a financial statement on the accrual basis, that you should at least try to calculate your revenue by quarter. And I know that's very difficult for a lot of firms that are dealing with those fixed fee profit issues. Unfortunately, the guidance just is not there. And the concern is that if we don't do that, depending on the loan amount, if there's an audit and they ask you to sort of prove out your quarter by quarter revenue, if you wait until the end of December to make all these percent complete adjustments, they would see quarter one, quarter two, quarter three, and then quarter four would have this huge adjustment to it, bringing in income potentially as a result of those percent complete adjustments. That may cause them to say, you have to take that back and tell us what happened in each of those quarters. So again, we wish we had a simple answer for you, and it's really complicated. And we're hoping the guidance comes out to quantify that, but it is an issue that a lot of firms are grappling with.
That was the only question. So I think we can go on to the
Okay.
last.
All right,
So
remote workers. Yeah,
just to finish it off with another topic that we don't have a lot of clear answers on. We'll talk about remote workers. So states that have, several states have what they call a convenience of the employer test, which allows them to reach across their borders and source income to the state using a more expanded approach to normal sourcing rules. So in most cases, somebody works in a state, their wages are sourced to that state. However, when an employee works from home for their convenience, this convenience of the employer rule states that those days worked from home may be considered to be worked in their home state, in their employer's home state. So Arkansas, Connecticut, Delaware, Nebraska, New York, and Pennsylvania currently follow this methodology, and New York has been probably one of the most aggressive in going after it. Beginning last March and April, Massachusetts adopted a similar methodology on a temporary basis with respect to people that had previously worked from a Massachusetts office. And the guidance has said that if you are now working from home outside of Massachusetts, you are still deemed to be working, you're still deemed to be a Massachusetts employee. Initially, that guidance was slated to expire on December 31st of 2020, but has now been extended until 90 days after the state of emergency is lifted. So let's say somebody works in New Hampshire, lives in New Hampshire, but works in Massachusetts normally prior to the pandemic. Their office closed down. They went home and have been working out of New Hampshire the entire time. Massachusetts still considers them to be a mass employee with mass withholding required. New Hampshire has not gone away without kicking and screaming on this one. They have filed suit. They feel it's unfair to their residents. They have filed suit against Massachusetts with the U.S. Supreme Court. It's not known. The Supreme Court has not yet indicated whether they'll hear the case, but it is a distinct possibility. Currently, at least 14 states have filed amicus briefs siding with New Hampshire. Interestingly enough, one of the states that has filed an amicus brief is Connecticut, which has its own convenience of the employer test. So I was sort of like confused for a minute is to try to figure out why Connecticut would side with New Hampshire when it, if New Hampshire wins this case, it would invalidate their own law. But best as we can figure out, Connecticut only passed a convenience of the employer test to sort of fight back a little bit or try to compete with New York, because a lot of people that New York were covered, were hit by the New York convenience of the employer test are Connecticut residents. So Connecticut felt that the only way they would be able to fight back would be to have a similar law. And we believe they support New Hampshire in this because if it's invalidated, it would invalidate the New York convenience of the employer test as well, and might open up some tax revenue for Connecticut because they would now be able to tax their residents rather than New York being able to tax them. So that's a long-winded way of saying we're not really sure what this is going to play out. But again, if you do have employees working from home outside of your normal state, particularly Massachusetts, it is something that needs to be looked at. It's something you need to discuss with your CPAs. It also, on an ongoing basis, if it's a permanent arrangement, could create income tax nexus in that state and require you to file an income tax return if you're not already doing so in that state. So again, an area we don't have a lot of answers on, but is worth some discussion.
And obviously would require you to potentially change your payroll if you're processing everyone through Massachusetts as a Massachusetts employee, but they live in another state. It may require you to change the payroll sourcing and open up payroll in that state, which obviously brings forth a lot of other compliance requirements just on the payroll side.
Great. Thank you so much. I can't believe it's already 1 o'clock. Does anyone have any final questions? You're welcome to unmute and just chime in. I'm just curious, was Rhode Island one of the states that filed support of that? We have people in Rhode Island.
I don't believe they have filed a brief, but I believe they have adopted they're allowing, if you are formerly a Mass employee that lives in Rhode Island, I don't believe I believe they are allowing Massachusetts to tax you. So you wouldn't, in most cases, you won't be double taxed. You'll always be able to take a credit for the taxes you pay to your employer state.
I just had a quick question. I just missed what you had said. You said on the PPP, the second round, the deadline to apply is March
31st.
31st. Thanks.
And do you know with the second round, I know in the first round they had a time frame that you had to compare a full-time equivalent to. Have they determined on the second round what the comparison periods are going to be? Will they be the same or will they be different?
Yeah, as far as we know, everything is sort of as Steve alluded to or talked about for the retention credit. All the base periods are the same, so you'll compare still to 2019.
But for payroll protection forgiveness, if you've dropped employees down to 80% or something like that, like, are they going to go back to 2019 when they were 100% and compare?
Yes.
Or
yeah, that's what we currently believe, is that when you look to forgiveness for round 2, similar to round 1, they're going to look at the base periods in 2019 and compare that to your head count in 2021. And so if you're lower, then and you don't restore those employees by a certain date, then you would lose forgiveness.
so the head count is one thing because the number of bodies can stay the same. The reduction in payroll was up to 25%. As long as you were, if you reduced it less than 25%, you were okay in the first round. So that's same for the second round, right?
And let me just, if I could answer the first one first, Dan. So FTEs, it's not head count, it's FTEs. So you do have to look at the hours worked, not necessarily bodies. So it is important to calculate it based on FTEs. And then in terms of the salary reduction, again, everything that I'm aware of, and Steve certainly jump in, is they're going to look to what was the base pay in 2019, what is it in 2021, and have you reduce that by more than 25%. And that's only for employees that were making really $100,000 or less. Anybody above 100, that if there were any cuts, it won't impact forgiveness.
Great.
Would you clarify any of that, Steve?
No, I think you're fine.
Great. Well, I know we've gone over time. Does anyone have any final thoughts or questions?
I only had a quick question about remote employees. I was just wondering, what about folks that are just leaving the city or leaving Massachusetts to work remotely just for a period of time, not moving specifically, not living in New Hampshire or living in Rhode Island permanently, like that's where their mailing address is, but just like escaping Dodge for 2 months during the winter, because why wouldn't they? Their office is closed, nothing. Just wondering if that's like a individual tax concern for the individual or something that the company should be thinking about as well.
Well, it could be for both. It could be an issue for both sides. It really depends on the state. The problem again in this area is that each state has a different rule. Everybody some states have issued guidance with respect to presence in the state due to the pandemic. Others have not. I think practically speaking, a lot of businesses for a short-term presence are not worried too much about it because the administrative aspects of it are pretty significant.
Sure.
I can't tell you that's always the right answer, but I also it's tough for me to say that you should be paying somebody to research every single state for a couple month presence either.
No, we had someone who like relocated to Minnesota, and so we ended up like just payrolling out that person to through a different company just because we didn't want to set up a tax liability in Minnesota. But we've also had people, that have gone to Vermont for 4 weeks and worked remotely because they didn't want to be in their apartment in downtown Boston anymore. So I think we're looking at, both situations, but I think that's helpful, and at least it gives us something that we need to pay attention to.
Yeah, I mean the right advice is really to look at the rules of each state, but that can be time consuming and costly, but that's the technically correct answer.
Okay, Roger
but
that.
Practically speaking,
yeah, I hear you. You don't have to say it on a recorded video. All right.
Great.
Thanks, Ann.
All right. And with that, join me in thanking both Chad and Steven. Thank you so much. This is really great. I really appreciate it.
Thank you very much.
okay.
Bye.
Thanks.
Thank you.
Bye, everyone.